In this video, we are going to walk through how to calculate the quick ratio. The quick ratio measures a company's ability to pay its current debts or liabilities with its most readily available current assets or resources. Current in this context means due or turning into cash in less than 1 year or operating cycle, whichever is longer. Generally, we will use the 1-year cutoff for current assets and current liabilities. When interpreting the quick ratio, it would generally be better to have a larger quick ratio than a smaller quick ratio. We would normally expect that the quick ratio would be 0.9 to 1. A quick ratio of less than 0.9 may indicate problems paying bills. These statements are all general in nature. There are always exceptions. The quick ratio is a more stringent measure than the current ratio. The quick ratio is also known as the acid test ratio. The quick ratio is always more useful when it is used for comparison than by itself. The quick ratio can be benchmarked against the quick ratios of companies in the same industry. A company's quick ratio can also be analyzed over time. Generally, it would be desirable to see a quick ratio that is increasing or remaining stable over time. The quick ratio is analyzed by taking the sum of cash plus short-term investments plus net current receivables and dividing that sum by current liabilities. These assets are the assets that are most quickly available if needed. Here we have 3 years of current assets including cash, net receivables, and inventory, and current liabilities for a company. We are going to calculate the quick ratio for each year. To calculate the quick ratio for the most recent year, we would take the cash and net receivables for the year and then divide that sum by the current liabilities for that year. Here we get 0.9 for the most recent year. In this example, we do not have current investments like in the quick ratio equation. That's okay. Companies do not necessarily have every type of account in a ratio. We will do the same process for the prior year. Take cash and net receivables and short-term investments, if they have any, and divide that sum by the current liabilities in that year. We arrive at 0.8 for that prior year. And finally, for 2 years back, we do the same process. The current ratio is calculated as 0.75. Now that we have the quick ratios for the 3 years, we can see that the quick ratio has been improving over the 3 years. Remember, a larger quick ratio is generally better than a lower quick ratio. Generally, we would like to see the quick ratio to be 0.9 to 1, so this company is generally in the safe range, although earlier years are below that lower threshold of 0.9. That's it, we are done. This video was created and narrated by Dr. Wendy Tietz and is part of the Accounting Skill Builder video series. See accountingisanalytics.com for additional faculty and student resources.